$150 billion. I mean, just try to wrap your head around that number. It's so big, it almost feels fake, right? It's more than the entire economic output of a country like Hungary. But it is very, very real. This is the estimated amount of money Elon Musk has borrowed, using his own Tesla stock as collateral. It's the fuel that powers everything. So that brings up the big question, the one we're here to unpack. Is what we're looking at a new kind of financial genius, a masterclass in building a 21st century empire, or is it the biggest, most complicated trillion-dollar house of cards the world has ever seen, just waiting for one stiff breeze to send it all tumbling down? To really get what's going on with the whole Muskonomy, you've got to understand one single concept: leverage. See, for billionaires, debt isn't what it is for the rest of us. It's not a burden, it's an engine. In fact, it's a superpower. I mean, it's like we're living in two totally different financial universes. For you and me, debt is a liability, right? It's your mortgage, your car loan. It's something you have to grind away at, paying it back piece by piece. But in Musk's world, debt is an asset. It's a tool you use to buy other companies, to expand your control. And this is key, it's incredibly tax efficient because you're not selling stock and paying capital gains tax, you're just borrowing against it. Okay, so how do you even start building an engine like that? Well, you need fuel, a whole mountain of it. And that brings us to playbook number 1, the payday. And we're not talking about a nice salary here. We're talking about engineering the biggest, most mind-boggling compensation package in the entire history of business. And what a saga it was. This thing was a total legal roller coaster. Back in 2018, Tesla gets this $56 billion pay package approved. Then, a court in Delaware strikes it down, literally calling the amount unfathomable. But then, in this wild reversal, the Supreme Court puts it back on the table. And just when you think things can't get any crazier, with that deal in the bag, the shareholders greenlight a new package, potentially worth up to $1 trillion. So you're probably asking, how on earth do you justify that kind of money? Well, here's the justification. During that exact same time, he delivered truly astronomical growth. The company's value just exploded, from $54 billion to $1.5 trillion. He hit every single one of the crazy, ambitious goals they set for him back in 2018. And the legal thinking here is pretty fascinating. The main argument against the payday was, hey, the guy already owns a ton of stock. He's already getting rich as the company grows. But the court said, nope. They basically established that a CEO's direct work in making that growth happen deserves compensation on top of the stock they already own. And that decision was crucial. It cemented his claim to that huge pile of shares, the very collateral he'd need for everything that came next. So that brings us to the next play in the book. Once you've got that mountain of stock, you turn it into a personal ATM. You get a river of cash, and here's the magic part. You do it without selling a single share. And here's the crazy thing, a real paradox when you think about it. The richest man in the world doesn't really have a lot of cash. He's not sitting on billions in a bank account. His wealth is all tied up in stock. So when he wants to buy something, like a social media company, he has to borrow the money. And we're not talking about a small loan here. The scale is just mind-blowing. To get $12.5 billion in cash to help buy Twitter, he had to put up $62.5 billion worth of his Tesla stock as collateral. Think about that ratio for a second. The banks demanded 5 times the value as a cushion, which tells you they are very, very aware of the big risk in this whole strategy. And that right there, that's the whole ballgame. The single point of failure, the Achilles heel of this entire financial empire. This beautiful machine of borrowing against stock to fund the next big thing, it works perfectly, as long as the stock price, the foundation of everything, goes up or stays flat. The real question is, what happens if it doesn't? And we'll get to that. All right, now for playbook number 3. This is where things get really sophisticated, like a piece of corporate magic. We're talking about a move that lets you acquire a massive company and build a financial fortress around your main business to protect it from any trouble. So here's how they did it when SpaceX acquired xAI. It's called a triangular merger, but it's simpler than it sounds. Step 1, SpaceX just creates 2 empty shell companies. Step 2, xAI, the company they're buying, merges with the first shell company, and its owners get SpaceX stock as payment. Step 3, that new combined company then immediately merges into the second shell company and poof, it becomes a tidy, wholly owned part of SpaceX. It's a bit of corporate shuffling, but it has some powerful effects. And why go through all that trouble? Well, the perks are huge. For the folks who owned XAI, it's basically a tax-free deal for now. More importantly, it lets SpaceX sidestep some tricky debt rules that could have meant paying back billions of dollars right away. And here's the fortress part. It builds a firewall. Any of XAI's legal headaches or regulatory problems get trapped inside that subsidiary. They can't touch the parent company, SpaceX. Okay, so we've seen how the empire is built. We've looked at the playbooks. But now we have to talk about that risk we mentioned, the physics of how it could all come crashing down. Because in a system this leveraged, things don't just bend, they snap. And the name for that trigger, that big red button, is a margin call. Now, the textbook definition sounds boring, but the simple version is anything but. It's your banker calling and saying, hey, that stock you promised us as collateral, it's tanking. You need to give us more cash or more stock right now. And if you can't, we're going to start selling your shares for you to get our money back. And we don't need your permission. And look, don't for a second think this is just something that happens to small-time traders messing around on an app. Margin calls have taken down financial giants. Billionaires are not immune. And when it happens on that kind of scale, it doesn't just wipe out one person. It can send shockwaves through the entire system. If you want a real-world horror story, just look at what happened with Archieagos Capital back in 2021. One day, this guy Bill Huang is running a $22 billion fund. The next day, a few of his stocks dip a little, the margin calls start coming in, the banks don't mess around, they start a fire sale, just dumping his assets on the market. In 2 days, he loses $20 billion. The entire fund just evaporates. That Archegos story is, well, it's a chilling reminder of just how fast and brutal a leverage collapse can be. Which brings us right back to our big question. Could something like this actually happen to the vast, interconnected empire that is the Muskonomy? Okay, so to really understand the risk here, let's look at the numbers. When Musk took out those massive loans to buy Twitter, Tesla stock was flying high, trading around $900 a share. That was the value of the collateral. But this is the number that matters. This is the tripwire. Analysts have crunched the numbers, and they estimate that if Tesla's stock price drops below $570 a share, the margin calls begin. That's the price that starts the dominoes falling. And here's why that's so incredibly dangerous. A margin call on this scale isn't just one event. It kicks off a terrifying feedback loop. The stock price falls, the bank makes the call. If Musk can't come up with billions in cash or other collateral on the spot, the bank starts force selling his Tesla shares. But dumping that much stock floods the market, which pushes the price down even further, which then triggers another margin call from a different bank, leading to more forced selling, and the whole thing spirals downward. And you've got to understand, the fallout from something like this wouldn't just hit Musk, it would hit everyone. As CNBC's Brian Sullivan once said, for a huge part of the investment world, Tesla isn't just important to the market, it is the market. A forced fire sale of that stock could trigger a chain reaction of losses across the entire financial system. So, after all that, we're right back where we started. It's a $1 trillion bet. And whether you call it genius or you call it gambling, you have to admit the financial architecture is brilliant. But the risk, it's systemic. Let's just lay it all out, side by side. The massive pay package. The upside was an incredible reward for incredible growth. The downside is it set a risky new standard for everyone else. The stock loans, they unlocked billions in cash, turning paper wealth into real power. But they also created a fragile system with a single point of failure: one stock's price. The fortress merger, it built a shielded, powerful empire, but it also added layers of complexity that make it almost impossible to see where the real risks are hiding. Every single move that amplified his control also magnified the potential for failure. Look, what we've just walked through is, without a doubt, a masterclass in financial architecture. It's a system brilliantly engineered to amplify success at every single turn. But it leaves us with one final nagging question. In its relentless pursuit of success, was this system ever truly designed to withstand failure?